Man, April's already half over. Can you believe that? Hope you got your taxes done. I hate April 15th. All right, let's talk about what's going on, guys. It's been a wild couple weeks. I think you know that. Let's get to the slideshow version here. Um, by the way, I realized that that cover page said March. I know it's April. But anyway, rates. They've been wild. They're back in that high six. If you haven't been paying attention, look at this fluctuation. So remember, guys, green is good. Like the higher this is, the better rates are, the lower rates are. So it's like opposite. And all of a sudden, we thought, and I texted the team right at the end of March, beginning of April, I was like, guys, like refis are coming. Let's go. And then all of a sudden, boom, rates just got smacked down. Now, the good news is the last 2 or 3 days, we've had a nice little bounce back. That's good. So let me break this down real quick, more than normal. Normally I just skip this, but I think it's really important. So again, you can look, guys, right at the very beginning of April, rates were getting really, really good. And you see that little purple lock? That's when we locked our pipeline. So again, rates got really good because the tariffs went into effect. Everybody was scared. The world's coming to an end. The stock market lost like 10% of its valuation in like 2 days. So all that money from all that concern and worry moves money from things like equities. Then they come over into things like bonds and mortgage-backed securities. And so that's why we had this nice little run up for about a week, week and a half, and people were freaking out. Well, then once they said, Trump kind of moonwalks a little bit and says, hey, just kidding, we're going to reevaluate, we're pushing pause for a minute. Then all of a sudden, the money goes away from us and back into the markets. And that's where that pendulum swung pretty big. Now, the good part of it, and I put the little yellow circle, it's kind of hard to see. I recognize that, but it's called a golden cross. And what does this mean? That black squiggly line, that's the 50-day moving average. And the longer, slower, less pronounced kind of flat line is the 200-day moving average. That means the last 200 trading days, that's the average. The last 50 trading days, that's the black line average. So anytime you see the black line come above the blue, that's called a golden cross. And that's usually a good thing. So it means, yes, we're below it just because the knee-jerk reaction for the last 2 weeks. But the reality is, for the future, it means it becomes a kind of buoys things and keeps them up. So again, up in this case means lower rates. So we've been saying it, we'll continue to say it. I do think the second half of this year we'll start seeing some improvement in rates. They won't be dramatically lower. I think it'll just be over time. We might take 2 steps forward, 1 step back, but at the end of the day, I do think we'll start seeing this, and this is a good sign that at least can be a harbinger for good news coming up. Lacey Hunt, big economist. I like him a lot. I followed him for many, many years. His forecast, he has basically said 3.8 on the 10-year Treasury. Now, the 10-year Treasury is not mortgages, but they do closely mirror each other. And so today's Treasury is at about a 4.3. So he's basically saying half a point lower coming up. So in theory, we should be able to say half point lower, and rates will be coming up for this year. So time will tell. He sees unemployment about 4.7. He thinks just, everything in general should lead that direction. So again, he's basically on board with us, which is not to say that I created my opinion. He is part of one of those reasons why. I just follow some smart people and I regurgitate what they say. And I obviously pick and choose who I follow, but I do feel like that's a very positive sign that we should see lower rates in the future. Why does that matter? Homeowners, and we've said this many, many times, but this is now new data, at least new pretty charts. Homeowners have drawn the line at 5.5% for their mortgage rates. So they've said, hey, 5.5%, 54% would say they would only accept a mortgage rate of 5.5. And we've been saying that 5.5 is that magic number where the world comes. Now, I don't think, quite honestly, I don't think we're getting to 5.5 anytime soon. I think at the end of the year, we're going to be in that low to mid 6. We might hit 5.5 if something really terrible happens in the economy. They are predicting, they being economists, are saying that either in or going to be in a recession. I've heard the word mild recession. So time will tell. We'll see. I don't think rates are getting to 5.5, but they can based on incentives. And by the way, that last line, 39% of people predict rates will end 2025 between 6 and 6.5. I'm in that 39%. So you can see the average and who predicts what. And by the way, if rates were under 4%, 100% of people say they'd buy. I agree with them. I don't see that happening either. So appreciation, and the reason why I'm bringing this up, because I just mentioned something that I'm kind of tying all this together. Appreciation is still up 4% year over year. 3.9 to 4, big deal. It's like the same thing, right? So 4%. FHFA, that means everybody with a conforming mortgage. So no, air quotes, normal houses. Take out the big jumbo ones. Take out the ones that are paid free and clear. kind of the normal houses, they're up almost 5%, 4.8, give or take. So appreciation's still good. This was interesting. So these are the lowest, or I guess the strongest and the weakest appreciation. Atlantic City, you're going to win with 5%, according to Zillow, as far as the appreciation. On the right side, it was interesting. Two Texas, Odessa and Beaumont. Big oil. Maybe that's why, because I know oil is projected to go lower. These are supposedly going to be two markets that lose value. So in the very worst, three, I have Midland at the bottom. I didn't even see Midland. Three Texas cities are among the quote weakest in terms of forecast. The weakest in the entire United States. The part I want to make up, guys, is 3%. That's not 30%. Like people are like, oh, there's a housing bubble. At the end of the day, guys, 3%. I don't want Midland to lose 3%, but if they did, it's not the end of the world. They are very like Odessa, Midland, and Beaumont and Shreveport. Look at all these like oil places, right? New Orleans. Those are cyclical based on just what's going on, not from real estate, but perhaps the demographic or geographic area is probably a better way to say that. Geographic area, economic area. That's what I was looking for. So again, just understand like housing meltdown, all this stuff. I just don't see it. I don't think it's coming. Builder confidence. The tariffs would supposedly add $9,200 per home if the tariffs go into effect and stay in effect. So time will tell. Builder confidence is waning. It's down to like 39.50 is like kind of normal. So I don't think it's like out of 100. When it's above 50, builders are like feeling good. Below 50, the builders not so good. So right now they are not so good. The part that blows my mind is it says only 59% of builders are using incentives, sales incentives. That's crazy to me. Remember the previous slide saying rates at 5.5? Builders, if you got the incentives, show buyers a lower rate. It will help them make the decision. In fact, 4 out of 5 aspiring homeowners are struggling with things that relate to those incentives. 81%, and I think this is crazy to me. 81% say the down payment and closing costs are what blocking homeownership. Guys, like DTI, like qualifying, and that is on the right side. Like income isn't high enough. To me, that should be the determining the deterrent, the deterrent to get somebody in. Because again, if your income's not enough, you can't just change that overnight. Not having the assets, that's a combination of time with some savings, maybe a gift. Maybe they don't know 0% down because you see the other highlight on the left. Typical down payment, 63 grand. You don't need 63 grand to buy a home. You don't need 16% down payment. There are absolute zero down programs. There's 5%, 3%, 3.5%. Like, do a better job. Us as individual or industry professionals, we need to make sure we're conveying the possibilities of what homeownership can be. Don't let the closing costs that a seller can pay for block the homeownership. Don't let them think they have to have 20% for down payment. They might from a DTI standpoint. DTI is a whole nother thing, but don't let those costs be the deterrent. The Mortgage Mark Program of the Week. We've gotten a lot of calls lately about A6, cash out refis. So if you have questions, they are a funky program. We're just highlighting it because the highest amount of equity exists here in America ever, over $1 trillion. And by the way, the highest, $1 trillion is the credit card debt. The $1 trillion of credit card debt exists, and it's the highest amount of equity we've ever had. So if you have credit card debt or know somebody does, or bad debt in general, or just need to consolidate, I know giving up a 4-point whatever interest rate stinks, but at the end of the day, if it can save you $1,000 a month in cash flow, we've absolutely seen that. To where if somebody needs it, call us, reach out to us. We'd love to help. Yes, that's a shameless plug, but it's a good one. Let's make it happen. Have some fun. America's $29 trillion economy by state. You can see California at 4.1, winning the race. Texas, close second, 2.7. That's in the lower left. I just thought this was kind of fun, interesting to look at. 3D printing houses. We did this story, I want to say a year and a half ago. Lennar, I didn't know Icon, but Lennar is doing 3D printed homes in Austin area, Georgetown, and 75% are already sold. I just literally, when I saw it, when we sent the article that we did this a year ago, literally a big thingy is just like printing the outline of the house. It's wild to me. So it reduced the construction time by 50%. And I think it was like a dozen people per home. Yeah, there it is. A dozen workers per home were reduced. This is crazy to me. We're doing 3D printing on homes. Good for us, good for them. We'll see if this sticks and ends up being profitable. Who knows? Consistent investing, talking to one of my employees about just what it means to put money into their 401k when they're young. You put $1,000 in, $1,000 a month, and I know it's a lot, But if you did it even just $1,000 and just closed your eyes, 10 years later, it could be worth 400 grand. So if you kept doing that every single month, holy smokes, like that's a big number over 15 years for just closing your eyes and not doing anything. So whether it's $100 or $1,000, it doesn't matter. I just picked 1,000 because I found a neat little graph that did that. But the reality is, invest today, and close your eyes and just wake up 15 years from now like Rumpelstiltskin and you'll have money. I promise. It works. I've done it. It's fun. American employees, they voted for the best places to work in 2025. I will give credit where it's due. Fairway Independent Mortgage. Good for you guys. Congratulations. You're number one. But look in the bottom left. CMG, our company. We're the 6th best place. And that's not mortgages, guys. This was just all companies. So there's a CPA firm in there, healthcare, insurance. But doggone it, we were 6th. Not quite on the podium for the top 5, but dadgummit, we're happy and proud about it. Mortgage Mark meme of the week. My kidnappers return to me after listening to me talk about real estate, or in my case, mortgages, for 6 hours. I thought that was funny. Ralph is great. Guys, you know what to do here. Share, subscribe, forward, all that fun stuff. Hope you found this valuable as usual. If you did, like I said, give us some love. If you didn't, you probably stopped watching by now. We appreciate you so much. Have a great rest of the week. Bye-bye.